Assalamualaikum warahmatullahi wabarakatuh. Firstly, we will explain the type of merger and acquisition in the Sime Darby and UMW case. Sime Darby Berhad is one of Malaysia's oldest and largest multinational conglomerates, originally incorporated in 1910. The company later restructured into a more focused business entity, with its main division being automotive distribution and industrial equipment, which are also its key revenue drivers. Sime Darby operates across more than 26 countries and is involved in a wide range of sectors. UMW Holdings Berhad is a prominent Malaysian industrial conglomerate with a strong concentration in automotive-related activities. These include vehicle distribution, manufacturing, engineering, and aerospace operations. Through subsidiaries such as UMW Toyota Motor, the company held principal distribution and supply rights for Toyota and Lexus vehicles, and also played a significant role in the national car market through Produa. The transaction between Sime Darby and UMW is best described as a horizontal acquisition because both companies operate in similar automotive and industrial sectors, bringing together overlapping business interests under one corporate group. Next is why the merger and acquisition took place. The merger and acquisition took place merely to support Sime Darby's strategy of expansion and market consolidation in the automotive and industrial sectors. In August 2023, Sime Darby announced its conditional acquisition of 61.2% of UMW shares from Pemodelan Nasional Berhad. This acquisition positions Sime Darby as a leading player in Malaysia's automotive industry by integrating UMW's Toyota and Produa product lines into its existing motor portfolio. By March 2034, Sime Darby completed the acquisition of the remaining UMW shares, resulting in full ownership and officially making UMW a wholly owned subsidiary. According to the company's strategic master plan, this move supports the expansion of its core automotive and industrial equipment operations in key regional markets. Overall, the acquisition strengthens Sime Darby's competitive advantage by consolidating major automotive distributors, improving economies of scale, and supporting long-term earnings and sustainable growth. Next, we will explain the main reason for the merger and acquisition. Thank you.
Today I'll present about the main reason for the merger and acquisition. Its merger was mainly driven by Sime Darby goals to expand its automotive market presence. Before the acquisition, Sime Darby focused more on premium and commercial vehicle, while UMW dominated the mass market segment through Toyota and Produa. By acquiring UMW, Sime Darby was able to serve a wider range of customers and become one of the most comprehensive automotive group in Malaysia. Another important reason for the merger was to strengthen domestic and regional competitiveness. According to PNB, this consolidation aimed to create stronger Malaysia automotive champion. This merger aligned with Malaysian New Industrial Master Plan 2030, which focused on industrial consolidation and regional competitiveness. The acquisition also allowed Sime Darby to diversify its business portfolio. UMW operates not only in automotive distribution, but also in manufacturing, engineering, equipment, and aerospace. This diversification reduces reliance on clinical markets and provide multiple revenue streams, improving business resilience. Operational and financial synergies were a key motivation behind the merger. By integrating UMW, Sime Darby can share logistic, procurement system, and after-sales service. The larger scale improved bargaining power with supplier and help reduce operational costs, leading to better efficiency and profitability. This acquisition aligned closely with Sime Darby long-term strategic growth plan. The company aims to strengthen its core industrial and motor business while increasing earnings from Malaysia and key regional markets. UMW now operates as a core division within Sime Darby, supporting this long-term vision. Finally, the merger significantly enhanced Sime Darby market share and competitiveness advantage. The combined group commands large portion of Malaysian total industry vehicle volume. This scale allows Sime Darby to respond better to future challenges such as electrification, regulatory change, and evolving consumer preference.
Next, I will explain liquidity ratios, which are used to assess a company's ability to meet its short-term financial obligations using its current assets. There are three main liquidity measures discussed in this section. The first is the current ratio, which is calculated by dividing current assets by current liabilities. This ratio shows how well a company can cover its short-term debts with its short-term assets. The second is the quick ratio, also known as the asset turns ratio. It is calculated by subtracting inventories from current assets and dividing by current liabilities. The third measure is net working capital, or NWC, which is calculated as current assets minus current liabilities. A positive net working capital indicates that the company is able to finance its day-to-day operation effectively. Before the merger and acquisition in FY 2023, the company recorded a current ratio of 1.48. This suggests that the company had a relatively strong short-term liquidity position. The quick ratio for FY 2023 was 0.7, indicating that the company was able to cover most of its short-term liabilities without relying heavily on inventories. Net working capital before the merger stood at 7,030 million ringgit, showing a positive and healthy working capital position. After the merger and acquisition in FY 2024, the company's current ratio declined slightly to 1.36. The quick ratio also decreased to 0.61, indicating a greater reliance on inventories to meet short-term obligations. Net working capital remained positive at 6,989 million ringgit, although it was slightly lower compared to the pre-merger period. Overall, when comparing both periods, the company's liquidity position remains stable, but showed a slight decline after the merger and acquisition. The reductions in both the current ratio and quick ratio suggest tighter short-term liquidity, while the positive net working capital indicates that the company is still able to support its day-to-day operations.
So my name is Nur Aisha Alia, and now I will continue with section 3.2, which focuses on the profitability ratios used to evaluate the merger between Sime Darby Berhad and UMW corporations. So we focus on three key measures: return on assets, return on equity, and net profit margin. So ROA shows how efficiently the merged firm uses its total assets to generate profit. ROE reflects the return created for shareholders, indicating whether the merger enhances shareholders' value. And then the net profit margin measures how much profit is spent from each ringgit of revenue, highlighting operational efficiency. Together, these ratios help us evaluate whether the merger improved overall financial performance and profitability. So with these formulas in mind, I will explain the actual results and what they reveal about the impact of the Sime Darby and UMW merger. Okay, so before analyzing the impact of the merger between Sime Darby and UMW, I will first discuss the profitability ratios before the merger in the year 2023. Okay, so based on the calculations, the return on assets before the merger was 4.5%, indicating that the company generated 4.5% of profit for every ringgit of assets employed. And then the return on equity recorded was 8.99%, showing a moderate level of return generated from shareholders' funds. Meanwhile, the net profit margin stood at 3.1%, reflecting relatively limited profit efficiency during the pre-merger period. Overall, these results suggest that before the merger, the company's profitability was stable but remained at a modest level. After that, I will now move on to discuss the profitability ratios after the merger between Sime Darby and UMW. Following the merger, the company's return on assets increased significantly to 7.94%, indicating improved efficiency in utilizing its assets to generate profits. And then the return on equity also rose sharply to 17.37%, demonstrating a strong improvement in returns to shareholders after the merger. And in addition, the net profit margin improved to 5.26%, reflecting better cost management and operational efficiency. So in conclusion, when comparing the profitability ratios before and after the merger, the results clearly indicate that the merger between Sime Darby and UMW has positively strengthened the company's overall profitability performance in year 2024.
For this part, I will explain the activity ratio focusing on inventory turnover before and after the merger. First, activity ratio measure how efficiently the company managed its inventory. In this analysis, we use average inventory and inventory turnover, which is calculated as cost of goods sold divided by average inventory. Before the merger in 2023, the average inventory was 1,843.5 million ringgit and total cost of goods sold was 40,120 million ringgit. As a result, the inventory turnover was 21.76 times, showing that inventory was sold and replaced quickly during this period. After the merger in 2024, the average inventory increased significantly to 30,096.5 million, while the cost of goods sold increased to 56,156 million ringgit. This caused inventory turnover to decline to 4.29 times. This decline indicates that inventory was converted into sale more slowly after the merger. The main reason is the increase in inventory level following the consolidation of UMW's automotive and equipment operations.
3.4 debt ratio. For the debt ratio, we utilize two primary formulas: the debt to equity ratio calculated as total debt divided by total equity, and the debt ratio, which is total debt divided by total asset. In terms of our performance, the calculation before the merger in 2023 resulted in a debt to equity ratio of 1.14 and a debt ratio of 0.53. Following the acquisition, this figure shifts slightly to 1.22 and 0.55 respectively. This increase indicates that the company utilized more leverage to fund its expansion. While the debt level rose, the change was controlled by the end of the period. 55% of our assets were financed through debt. This suggests that while we have increased our financial risk to grow the business, we have maintained a relatively stable capital structure that balances borrow funds with shareholder equity. 3.5 market ratio. Moving to market ratio, we use three key formulas: the price earning ratio, which is market price per share divided by earning per share EPS; the dividend yield, calculated by dividend per share divided market price and multiplying by 100; and EPS, which is net profit after tax divided by the number of ordinary shares. Looking at the result, the calculation before the merger in 2023 show a price earning ratio of 9.60 times, a dividend yield of 6.34%, and EPS of 21.4 cents. After the merger, the price earning ratio dropped to 5.40 times, the dividend yield adjusts to 4.69%, and EPS jumped significantly to 48.5 cents. The explanation for this shift is very positive for our shareholder. The massive surge in EPS from 31.4 to 48.5 cents demonstrate that the merger significantly boosted our bottom line profitability per share. Interestingly, because our earnings grow much faster than the market price, our price earning ratio actually become more attractive. Even though dividend yield decreased slightly due to the higher share price, the overall market position of the company has strengthened, showing that the acquisition has added substantial value to each individual share.
This slide explains the impact of the merger between Darby Berhad and UMW Holding Berhad based on the financial ratio. After the merger, liquidity slightly decreased. The current ratio fell from 1.48 to 1.36 and the quick ratio declined from 0.70 to 0.61. They show that the company had a slightly weaker short-term liquidity position. Net working capital remained positive, decreasing only slightly from 7,030 million ringgit to 6,889 million ringgit, which means the company was still able to meet its short-term obligation. Profitability improved after the merger. Return on asset increased from 4.5% to 7.90%. Return on equity rose from 8.19% to 70.37%, and net profit margin increased from 3.1% to 5.26%. Inventory efficiency declined in the short term. Inventory turnover dropped from 21.76 times to 4.26 times due to higher inventory level after consolidation. Financial leverage increased with the debt to equity ratio rising from 1.40 to 1.22, showing higher reliance on debt financing. Market performance improved as earnings per share increased from 21.4% to 48.5 cents, while the price earning ratio declined from 9.60 times to 5.40 times. Overall, the merger improved profitability and market performance. Although liquidity, inventory efficiency, and leverage experienced short-term pressure, they show that the merger was strategically beneficial and has potential to create long-term value once integration is fully completed.
In conclusion, the merger between Darby Berhad and UMW Holdings Berhad represent a strategic horizontal acquisition aimed at strengthening Darby's position in Malaysia's automotive and industrial sectors. Through this acquisition, Darby successfully expanded its automotive portfolio by combining mass-market brands such as Toyota and Croda with its existing premium brands, which enhanced its market coverage and competitiveness. Based on our financial ratio analysis, the post-merger period shows significant improvement in profitability, including higher return on assets, return on equity, net profit margin, and earnings per share. This indicates that the expected operational synergies and economies of scale have started to materialize. However, the merger also resulted in short-term challenges such as weaker liquidity, slower inventory turnover, and higher financial leverage due to increased inventories and debt financing. Overall, despite these short-term pressures, the merger can be considered strategically and financially beneficial. With effective inventory management and prudent debt control, this merger has strong potential to support sustainable long-term growth and enhance shareholder value. That will be all from us. Thank you.